Liz Ann Sonders is Charles Schwab's chief investment strategist and joins us now. It's nice to see you.
Nice to see you, too.
How would you answer that question?
I don't know. I mean, that's the honest answer. I think based on what we knew at the time, the near-term economic data was still pretty decent. I think we probably overshot at the April 8th lows or intraday on the 9th in terms of discounting the near-term negative impact of what was happening, or at least what we knew at that point. We may now have overshot on the upside in terms of just this delay suggesting that we're in the economic all clear. I think we're still going to be at the mercy of some of these headlines, but clearly we get these rip your face off rallies. I remember on April 9th, I was at one of our conferences and I was speaking that morning. It was before the announcement of the delay of the reciprocal tariffs, and talked about the nature of a market like this with high volatility, as you can get these rip your face off rallies. We may at some point near term get to more significantly overbought territory, and sentiment could provide a little bit of a swing factor. But this is an example of better or worse mattering more than good or bad, and things are better today than they were last week.
If they're good enough that I can take recession off the table, does that tell me that I think stocks are more fairly priced today than I might have thought last week?
If recession is off the table, then that's a fair bet. If you look at past serious corrections, meaning, you go down by more than 10%, but maybe you just come just shy of bear market territory using just the simplistic 20% rule, the differential when looking back at history of those severe corrections that either do or don't turn into bear market is generally that dividing line is recession versus no recession. I think the odds players are, for the most part that I've seen, have lowered the odds of a recession based on this. I don't know that it's been eliminated based on this, because we're still talking about a delay, not to mention the fact that, at least as it relates to imports from China, we're now talking about a 30% tariff. That's well better than 145%. But if just that had been announced on Liberation Day, that was a significant upside, maybe somewhat known shock. So I think the ripple effects into the economy have not fully eased by virtue of this. But even if recession is still in the realm of possibility, the magnitude has probably been diminished by virtue of this de-escalation.
That's kind of the Austin Goolsbee perspective this afternoon, speaking to the New York Times, that yes, maybe we've taken a lot of worst case off the table. This is my paraphrasing, obviously, not his direct comment, but that we are still susceptible to an economic shock from all of this that we may not have seen yet because of exactly what you say.
I think that's absolutely a fair point. We know there was a tremendous amount of tariff front running. That did a couple of things. It boosted inventories such that particularly many smaller companies that were really at the mercy of some of the tariffs on imports from China built a little bit of an inventory cushion. But even for the larger companies, the buildup of the inventory cushion coupled with the 90-day delay means that I think companies can maybe play around with pricing to see what sticks. They've got the inventory base that they can do that, see what they potentially can pass on to consumers, what they might have to eat in profit margins. And so I think it still means that the economic outlook is tricky. What will be interesting to see is if there's any change in terms of the companies that have withdrawn guidance altogether, or whether we continue to see an on-pace number of companies withdrawing guidance, given what is still somewhat uncertainty. I think if you were to see some companies either that withdrew guidance or are now affirming guidance, that would be an important tell that the economic hit is one that they don't see as terribly detrimental. But we probably it'll take until next earnings season to get a sense of how stable profit margins are, and that's a function of how much flexibility companies have to pass on those price increases versus eat it in their margins.
Are there areas of the market that you just didn't like last week that the news of the weekend forced you to rethink about?
Well, Scott, I think we talked about it about a month ago. We neutralized our sector recommendations because of just rampant sector volatility. It's akin to what we did back in the early part of COVID when you had a large number of companies withdrawing guidance. It was an incredibly murky outlook and felt it was really tricky to try to have a tactical call on sectors. And for now, we stay in that mode, but we have been very factor focused. I think in a backdrop like this, some of the more stable-oriented factors like low volatility, like stable dividend yield. Those, I think, in this kind of risk-on environment, tend to fall down the ranking spectrum in terms of sector factors, and you get more of those traditional growth-oriented factors and higher volatility names, weak names finding some momentum. So I think there could be a factor shift, at least those that traders tend to focus on, away from those standard risk-off factors to more of the risk-on set of factors.